Welcome to Property Report UK, the channel where we break down the latest developments shaping Britain's housing market. Whether you're a homeowner, a first-time buyer, a property investor, or simply someone keeping a close eye on the UK economy, this is where we explain what the numbers really mean for you. Today we're looking at one of the most important factors influencing the housing market right now: mortgage rates. If you're thinking about buying a home, refinancing your current deal, or even just watching the property market from the sidelines, the direction of mortgage rates will likely play a major role in your decisions. And while headlines often focus on house prices, the reality is that borrowing costs can have an even bigger impact on what buyers can actually afford. The challenge for many people trying to keep track of the market is that mortgage rates in the UK change frequently. Lenders regularly update their products, sometimes multiple times in a single week, responding to shifts in funding costs, economic expectations, and decisions made by the Bank of England. As a result, the best rate available today may not be the same next week. That's why analysts track average rates across the market to give a clearer picture of where things are heading overall. To understand the current situation, we first need to look at the wider economic context. Over the final months of 2025, mortgage rates began to ease after a series of reductions in the Bank of England's base rate. In December 2025, the central bank cut the base rate by 0.25 percentage point, bringing it down to 3.75%. That move followed earlier rate cuts and signaled that policymakers believed inflation pressures were gradually easing. Lower base rates usually create room for lenders to reduce mortgage costs, although the relationship isn't always immediate. Lenders also need to consider the cost of funding mortgages through financial markets, which can fluctuate based on global economic conditions. By the start of 2026, many lenders had already adjusted their mortgage products to reflect those earlier cuts. Some headline-grabbing deals appeared toward the end of 2025 and into January, with certain mortgage offers dropping to levels not seen since before the market turmoil triggered by the 2022 mini-budget. For buyers who had been waiting for borrowing costs to fall, this was an encouraging sign. However, as we moved into February 2026, the pace of change slowed. On the 5th of February, the Bank of England decided to keep the base rate unchanged at 3.75%. The decision reflected a balancing act. Inflation had been gradually cooling, but policymakers still wanted to ensure that price pressures remained under control before making further cuts. In fact, inflation data released in January showed the UK's annual inflation rate had fallen to around 3%. That is significantly lower than the peaks seen during the cost of living crisis, but still slightly above the Bank of England's long-term target of 2%. For central bankers, that means caution remains the priority. As a result, mortgage rates across the market have largely stabilized in recent weeks. According to the latest figures updated in early March 2026, the average two-year fixed mortgage rate is currently sitting at around 4.30%. That's a small increase compared with the previous week, rising by roughly 0.5 percentage points. Meanwhile, the average 5-year fixed mortgage rate is currently around 4.44%, also slightly higher week on week. While these increases are modest, they illustrate how the mortgage market can shift even when the Bank of England itself has not changed the base rate. Looking at the lowest deals available in the market, the picture is a little different. The best 2-year fixed deals are currently starting from around 3.56%, while the most competitive 5-year fixed deals are hovering near 3.80%. These headline rates often come with specific conditions, such as larger deposits or arrangement fees, but they show how competitive lenders remain when trying to attract borrowers. One of the most important factors affecting mortgage rates is the size of a buyer's deposit. In the mortgage world, this is referred to as loan-to-value, or LTV. The higher the deposit you can put down, the lower the risk for the lender, and that typically leads to lower interest rates. For buyers with smaller deposits, particularly those putting down 5 to 10%, the average rates are understandably higher. For example, Buyers with a 5% deposit are currently seeing average 2-year fixed rates slightly above 5%. 5-year fixed deals for the same deposit level are just over 5% as well. For those able to put down a 10% deposit, rates are a little lower. 2-year fixed mortgages in this bracket average just over 4.4%, while 5-year fixes come in slightly above 4.5%. As deposits increase further, rates gradually improve. Borrowers with deposits of 15 to 25% are seeing 2-year fixed rates around the low 4% range. 5-year fixed deals for this group are generally slightly higher, but still comfortably below the levels seen during the peak of the mortgage crisis in 2023. At the other end of the scale, buyers with large deposits around 40% are accessing some of the most competitive deals in the market. For these borrowers, average 2-year fixed rates are now around 3.71%, while 5-year fixed deals sit just below 4%. But while interest rates are important, many buyers are ultimately concerned about one thing above all else: monthly repayments. After all, it's the monthly payment that determines whether a mortgage is truly affordable. Based on the latest property market data, the average monthly mortgage payment across the UK currently sits at around £1,592. That figure is calculated using the national average asking price for a home, which is approximately £368,000. For many households, that monthly cost remains a significant financial commitment. However, there is some encouraging news for first-time buyers compared with a year ago. The typical first-time buyer property outside London currently costs around £225,000. For someone purchasing a home at that price with an 80% loan-to-value mortgage on a 2-year fixed deal, the average monthly repayment now comes in at roughly £975 if the loan is spread over 25 years. That's noticeably lower than the same scenario a year earlier, when similar borrowers were paying more than £1,060 per month. In other words, falling mortgage rates over the past year have already started to improve affordability slightly for many first-time buyers. Even so, affordability remains a major issue in many parts of the country. Wage growth has improved somewhat, but house prices and borrowing costs still mean that many potential buyers are carefully weighing their options before committing to a purchase. Understanding how mortgages work is therefore more important than ever. At its core, a mortgage interest rate simply represents the cost of borrowing money to buy a home. The rate is expressed as a percentage and determines how much interest you will pay on the loan each year. This interest is then factored into your monthly repayments, along with the amount of the loan itself. Over the lifetime of a mortgage, even small differences in interest rates can significantly change the total cost of borrowing. There are also several different types of mortgage products available in the UK. The most common is the fixed-rate mortgage, where the interest rate remains unchanged for a set period, often 2 or 5 years. This provides predictable monthly payments, which many borrowers find reassuring during periods of economic uncertainty. Another option is a tracker mortgage, where the interest rate moves in line with the Bank of England's base rate. If the base rate rises, monthly payments increase. If it falls, payments can decrease. This type of mortgage can be attractive when interest rates are expected to drop, but it carries more risk if rates rise unexpectedly. Many borrowers also encounter something known as the standard variable rate, often abbreviated to SVR. This is the rate lenders typically move borrowers onto once their initial fixed or tracker deal expires. SVR mortgages tend to be higher than promotional deals, which is why many homeowners choose to remortgage before reaching that stage. Other mortgage products exist as well, including discount mortgages, offset mortgages, and interest-only arrangements, each designed to suit different financial circumstances and strategies. One reason mortgage rates change so frequently is that lenders constantly adjust their offerings in response to market conditions. The Bank of England reviews its base rate roughly every 6 weeks, and any change in that rate can quickly influence mortgage pricing. But the base rate isn't the only factor. Mortgage lenders also rely on financial markets to fund many of their loans, and those funding costs can move based on global economic events, investor expectations, and shifts in inflation forecasts. This means mortgage rates can sometimes rise even when the base rate stays the same, simply because lenders face higher costs behind the scenes. For anyone considering a mortgage, the key question is often how much they can borrow. That amount depends on a lender's affordability assessment, which typically considers income, existing debts, living costs, and overall financial stability. Loan-to-value also plays a crucial role here. The bigger the deposit you can provide, the smaller the loan relative to the property's value, and the more favorable the interest rate is likely to be. Many buyers begin their journey by using mortgage calculators to estimate what they might be able to borrow. Another common step is applying for a mortgage in principle, which gives an indication from a lender about how much they might be willing to lend based on initial financial information. While it's not a formal mortgage offer, it can give buyers more confidence when making offers on properties. Looking ahead, the big question for the housing market is where mortgage rates go next. Much will depend on inflation and how the Bank of England responds in the coming months. If inflation continues to fall steadily, there may be room for further base rate cuts later in 2026. However, economic uncertainty both in the UK and globally means the path forward may not be entirely smooth. For now, the mortgage market appears to be entering a period of relative stability, with rates hovering around the 4% mark rather than moving dramatically in either direction. For buyers, that stability can actually be helpful. It allows people to plan with greater certainty and assess affordability without the constant fear of sudden rate spikes. And for the broader property market, mortgage rates will remain one of the most important indicators to watch throughout the year. That's all for today's update from Property Report UK. If you found this breakdown useful and want clear, independent analysis of the British housing market, make sure you subscribe to the channel and turn on notifications so you never miss our latest reports. We cover the stories behind the headlines, from mortgage trends and house prices to government policy and the economic forces shaping property across the United Kingdom. If you enjoyed this update, please like the video as it helps